Welcome to the daily update where I'll go over the action in the market for Thursday, February 20th, and we'll see how things look for Friday, February 21st. Saw a pullback. We're still looking pretty positive, although we're not trending. We're seeing growth just really not doing very well, pretty much for the whole week. That's what was keeping the market more positive under the surface. And we're seeing in a lot of different areas where growth has been pulling back, not changing negative yet. A lot of the smart money may have come in, bought their growth at lower prices, and they're just kind of sitting back and waiting. But at some point, we're going to need growth to come back in and really push things a bit higher. Now, since we're not trending, we came up, set a new all-time high both on Tuesday and Wednesday. And then, of course, Thursday session saw some profit taking. The intraday action was fairly positive. We hit the low and we're able to bounce up out of that. So we're still looking positive right now. Our primary indicators are positive, but we're still not trending. And we're waiting to see if we're going to get into a trending mode. Okay, so right at the open, we had a lower open. We were down just about as much in Thursday session that we were before Wednesday session, but then we ended up coming back on Wednesday and being positive. We opened down below the daily pivot at 61.34. We went down below S1 at 61.21, S2 at 6,098. So we fell under the 6,100 level. That really didn't hold all that much. Now we would come back later, but we fell down below it. It looked like, uh-oh, we're going to break to the downside. Well, we found support right around the 60.80 level, and that's where things kind of stabilized. And then we chopped back above S2. So we were seeing that bounce coming in. And then we came back up and ended up closing just a little bit under S1. We were down 0.43% on above average volume. And we are still positive in the short, intermediate, and long term when you're measuring things based on moving averages. We're still above all of the short, intermediate, and long-term moving averages. Interest rates, we did drop down below 4.5% with the 10-year yield, so that could be helping stocks. And then the geopolitical things going on, the talks between Russia and the U.S. about Ukraine, things in Israel, those are all still very real. But there's also the domestic things going on in the U.S. with the confirmations and the executive orders and DOGE and all the different things happening there. And things are happening very quickly. And that's why the market is a little bit confused right now. It's having a hard time keeping up. Everybody's having a hard time keeping up. As far as some comments, we did see a decline after we set two new all-time highs 2 days in a row, Tuesday and Wednesday, and we're pulling back now. Growth and discretionary did underperform. Now, discretionary is still looking good compared to staples, but growth is it's still positive, and I'll show you some charts here, but we need that to kick back into gear. A little bit shorter list on a short-term basis when we look at those things that are extreme positive, or you could say overbought. The Stoke RSI that came off the list. Well, the Williams percent R is still on the list. Our stochastics are still looking extreme, and then we have our three smart money indicators, which are pulling back a bit here, but still looking extreme positive with accumulation distribution, the Chaikin money flow, and the Chaikin oscillator. In the intermediate term, the Arun indicator, that's still extreme positive. The Sean trend meter, which has declined but still looking extreme, and the ultimate oscillator, also declined but still looking extreme. No real change to the scenario as of late. The market is still anticipating a soft landing, meaning that we won't go into a recession. The dollar was down and interest rates were also down, and both of those could have helped stocks at least stabilize later in the day. We closed right at 4.5% with the 10-year yield, where we had been at 4.54%. Sentiment is still neutral. We ticked down a couple of notches, but we're still in that neutral range at 45, where we had been at 48. We're still not trending, but we're positive. The green line is above the red line. And with the negative day, but yet nice little comeback that we saw. I'm keeping our bias at mixed right now. There's just not a lot of conviction going on. And I'm also keeping our momentum at mixed because we're just not trending right now, even though you might lean it a little bit more to the positive side. We did get initial jobless claims came in at 219,000, and that's up from the 214,000 that we saw last time. The continuing claims also went up 1.869 million. Last time it was 1.845 million. The Philadelphia Fed index came in at 18.1, a little bit lower than the 20.5 they had expected, and down from the 44.3 we saw last time there. The leading indicators down 0.3%. They expected it to be unchanged. Last time it was up 0.1%. So here's a chart of the weekly jobless claims where they are going up. The moving average is continuing to go down. Continuing claims going up, but the moving average is also going down. And just to give it some more context, red are the initial jobless claims. You can see we've been trailing off for the most part. We've been pretty steady with the continuing claims here. And then I also have the unemployment rate on this chart as well, just to put these things together. The Philadelphia Fed index here, it was still positive, but quite a bit lower than the pretty big reading we saw last time. And then the LEI, leading economic index or indicators here, says it fell in January, reversing most of the gains in November and December. Okay, so it came down just a little bit there. And then the annual growth rate has been improving. And we're back above this red line here. When we drop below it, that's a recession signal. And you can see other times when that happened, the gray area, that's when we did go into a recession. Well, we went below it, but we, at least to this point, have not gone into a recession. Then looking at margin debt, this comes out about every quarter, and this is when people use borrowed money to buy stocks. And you use the stock that you already own as collateral. And we're seeing that really going up, where and that's kind of a warning sign when a lot of people start using borrowed money to buy stocks. Now it's great when everything works in your favor. It's like if you have $10,000 and it's a margin account, that gives you $20,000 of buying power. But then if that stock that you buy declines by 50, 60%, you still have to pay that $10,000 back. It's not like a 50-50 deal with your broker. You still have to pay back the full amount, and that can kind of avalanche into a problem. And we're seeing it pretty high right now, according to this put out by Real Investment Advice. Then once a bull market gets to 2 years old, there could be a lot left. We've seen other charts that say after 2 years, things really slow down. So it just depends on how you look at the different information. But the red line is this is the current market that we've been in, the red line up until now. It started in October of 2022, and things tend to go good after that. And this is looking out into 12 years in the future. Then equity positioning now coming down a little bit, but still above zero, as most folks are leaning still towards being into stocks. Now, this is a little bit contradictory than what I show. I usually go over something very similar to this in the intermarket analysis video on the weekend, and it breaks down the different PE ratios. And we have a 10, 15, 20 scale with those ratios. And when we're above 20, we're considered expensive. The NASDAQ 100, okay, it's coming in at 29. So that's considered expensive relative to being right around the 20 level. What I'm seeing a contradiction is with the Russell 2000. It has us at 25. The chart that I show every week has us down at 15. So, this is calculated in a bit of a different way here, but this would suggest that small caps are overvalued, where the other chart that we look at shows that they're fairly priced right now. The S&P, that's about the same level that we've been seeing for quite a while, and then the equal weight, which are the smaller stocks inside of the S&P, that's about where we've been at. We've been seeing it at about 18 or 19. And then the mid caps, this is what we've been seeing for quite a while. So I don't understand the discrepancy between the small caps and the mid caps here. So if you use this to make decisions, I don't. I just use this for informational purposes. You might want to double check some of these numbers to see if they line up with what you think. Then gold, it keeps going up right now. and it likes these tariffs and the threat of tariffs that may be enacted. So gold's been going up there. And then we have some housing data that came out here, and we are starting to go back up with the authorized permit issues that are coming out, and that's pretty good overall. I mean, first you have to get a permit to build something, and if that's going up like it has been lately, then that can be a good thing for growth in the economy. And let's see. Then mega cap growth and tech positioning, that's still where most of the money, excuse me, that's still where most of the money is, but we're still below this purple line here. We're not getting too extreme. And then profit margins, not only in the tech sector, but also throughout the rest of the S&P, we're seeing this going back up. The red line, now this is trailing and the market looks forward here. This isn't the PE ratio, but this is looking at profit margins that have already been reported and they're going up. And so companies are making more profits. And then this just shows how the Magnificent Seven stocks have really lagged so far in 2025. When this chart was done, they were up 1%, or the rest of the S&P, and it's not 493 because there's 503 stocks. But anyway, that's just how they figure it out here. The rest of the stocks are actually outperforming, and we've been seeing that in a lot of our charts, where the S&P itself was up right around 4% when this chart was created. I looked around Twitter, X, for a while, but didn't really see anything of interest there. So here's the intraday chart. So did have a lower open, and then we saw a lot of selling right away. Took us down below S1, S2. Then we stabilized. This is right around the 680, 60, 80 level or so. And there is one chart that I'll show later that may have provided some kind of support, but then we kind of chopped above and below S2, and then this is the encouraging part, is then later in the day, that's what we look for, is late day buying, and this is the smart money coming in, and they did do some buying and took us back above S2. We didn't quite get up to S1 by the close, but we did pair up a lot of the losses that we saw for the session. And we're not really all that changed in the initial overnight session over here, but we were drifting down a little bit as things were a bit weaker in Europe. And then we saw the big fall and then the comeback later in the day. We're still looking positive here with the blue line above the red line. This is growth outperforming value. So this chart is still hanging in there. This is trailing off a little bit. We were seeing a nice steady little trend going up from the end of January. When we look at intraday growth to value in the S&P, we're coming off of that a little bit. Now we could recoup and start to go back up. If we continue to go down here, that would be a little bit more of a concern. End of day growth was down where value was unchanged for the large caps, down more for the mid caps, and also down more for the small caps. So not a good day for growth. So we're coming back down here with our small cap growth to value ratio, the end of day chart. Still in an uptrend, but we were more encouraged when we were seeing this going on here. Lately, this has been kind of tracking with what the index is doing, which has not been much of anything. And mid-cap growth to value also was looking a lot stronger, now pulling back. We'll see if coming down to this 50-day moving average may offer some support and pulling back, but still in an uptrend with our S&P growth to value. So this is damage that could be repaired, but if we see more follow through to the downside here, that's going to be more concerning. And coming down a little bit deeper into the top end of the rainbow with this growth versus value ETF. This is also still longer term positive when we look at the ratio between discretionary and staples, but it is coming down right now and came down to the 50 period moving average with the large cap growth. We may have found some support off of that. We bounced once this particular ETF hit the moving average, and we're still above the 50 period moving average, but we're still not trending. The ADX, the dark black line here, that's going down. That means the trend is weakening, and we're still below the moving average. We're positive since the green line's above the red line, but the green line's coming down as the red line's going up. We're trying to stabilize a little bit here in the short term, but we haven't crossed back above the moving average. Still positive, but seeing the green line coming down and the red line going up. And we were slightly above average here with volume. Didn't see much of a change here. Just kind of going sideways right now on a closing basis with the VIX. There's not an awful lot of fear coming back into the market. We're also below the moving averages with the bar chart. And the VIX of the VIX also still underneath the moving average with the bar chart and the line chart. The momentum of the VIX is still down, and that's positive for stocks. And coming off of a really high reading here with the skew index, which is a variation of the VIX, it's coming down, but still giving us a very, very high reading, meaning that the market is expecting some kind of a big move. But we've been in this red area now for the last number of months, and that big move just hasn't happened yet. And seeing a discrepancy here, we declined with this one fear gauge and we went up slightly with this other fear gauge. And we every week we get the individual investor survey. They're negative, but it did improve from the previous week's reading. And tick down just a little bit here with the equity put call ratio, and we're back to going up with the 5-day chart, which tends to be negative, and we're also going back up with the 10-day chart, which is negative, and that's more confirmation. There's some hedging going on there that's lasting a little longer term, as folks are a little bit concerned about things. And coming up a little bit, but still in this band here when we look at volatility risk premium. So fear is picking up a little bit, but it's not getting extreme. Still looking positive with our advanced decline line based on price and volume, but volume has lately been leading price and actually doing a bit better. And coming down, but still above zero with our advancers decliners over the last 10 days. And still improving here when we look at our 5-day moving average, but we're starting to turn back down with our 10-day moving average as we saw a real drop off in the new highs, but really not much of an expansion of the new lows. And still above zero with our short and intermediate term advanced decline ratio. Still getting a very high reading with this smart money indicator number one going up still. Okay, it's kind of interesting, even though the boom indicator has it coming down. Disregard this for right now. This is trying to measure how far away is the indicator from the moving average, and it's not been very accurate now for a while. But this is still positive, and we're still going up with this smart money indicator number two, the chicken money flow. Now, you could suggest that we're looking extreme here. Doesn't necessarily mean we're going to reverse. It just means we might slow down, even though we're already in a non-trending environment. And we're going up here with the chicken oscillator. So our three smart money indicators are positive, but probably considered to be extreme positive now. And this is a little bit of a concern. We're positive with the vortex, but the green line's coming down as the red line's going up. And when we look at the S&P, we're still above the moving average with the advanced decline line. We're still above it with the NYSE common stock and the mid caps, where we're below the moving average with the small caps. And tick down a little bit, but still above 50 with those stocks in the S&P above their 20 period moving average. Came down but positive with the 50 period moving average study. Actually went up a little bit with the 100 period moving average study and ticked down just a little bit with those above their 200 period moving averages. So we were just barely above average with volume here, and we're coming up close to February now. So that's why you see these new pivot points being drawn in here. We ticked down a little bit with the 20 period and 50 period, but we were flat to slightly increasing here with the 200 period moving average study. And no longer extreme with the Stochk RSI. So that's wearing off and showing a little bit of a slowdown in the upward momentum. We're coming down, but still extreme with the Williams percent R. We're no longer extreme with the CCI 14 or 20. And we're coming down with the short-term stochastic, but still extreme, rolling over in the intermediate term. The long-term stochastic is still going up. And all three are extreme positive. And we came down, but we're still above the midpoint with the force index. We dropped below both lines here, the green line and the blue line, but the lines are still going up. This tries to measure the condition of the short-term trend based on 20 periods. We're still above the simple and exponential moving averages. Even with the decline, we didn't reach either one of those on Thursday. We came down into the +1 channel where we had gone up into the +2 channel. So a little bit of a pullback, but still looking positive. The balance of power, it was extreme. It pulled back down just a little bit, but it's still a positive reading. The go no go is still positive with the dark blue bars. We're coming down a little bit below this highest high value, but we're still well above the midpoint with this chart. And we're still going up a little bit here with the TTM squeeze. So it's still picking up a little bit of strength with the lighter blue, and it's going up. Where the ease of movement, it's been straddling right along between positive and negative. It's dropping a little bit further below zero now. This is the Arun indicator, which was asleep through the end of January and most of February, and then all of a sudden it woke up. It's still giving us an extreme positive reading as it tries to measure the difference between buyers in green and sellers in red. Coming down a little bit, but still positive with the McClellan oscillator for the S&P. So we're still going up based on price, and we're actually showing more conviction based on volume, which could be positive under the surface. And coming down, but still just barely positive with the NYSE McClellan oscillator. So we're still going up based on price and also going up based on volume. The swollen trending oscillator continues to go up based on price and volume, and it's actually been showing more strength here based on volume. Momentum is switching back and looking a little more positive. The PMO is going up. We're trying to turn back up based on price. We've already been going up here based on volume, but we declined a little bit with the PMOs that are rising. The buy signals bounced up and now they're leveling out, and we're still going flat with the PMOs above zero, where we've gone from positive to neutral with the Elder's Impulse system for the S&P. Parabolic SAR has the dots underneath. That's positive. And we're turning back up here with our short-term oscillator, the slope oscillator, coming back and starting to cross above its moving average. The MACD is still positive. So in the short term, we're positive. We're improving in the intermediate term, and we're still positive with our longer-term oscillators. The Copic curve trying to cross back above the red line here, which would turn that back positive. The Sean trend meter did decline, but it's still giving us an extreme positive reading. We're still above 50 with the money flow. We declined, but still extreme with the ultimate oscillator. Still above the moving average with on-balance volume. Still above 50 with the RSI 14 and RSI 9, even though both declined. The condition of the intermediate term trend, based on 50 periods, we're still going up. And we're still above the simple and exponential moving averages based on 50 periods. We're above all the moving averages here, and all the lines continue to go up. The bullish percent index is still positive. It improved just enough to continue to go up above its moving average. This is another primary indicator. And we declined a little bit here, but we're still positive with the NYSE bullish percent index and declined, but quite positive with the NASDAQ 100 bullish percent index. This is one of the support levels. This is just a 20 period moving average of the open, high, low, close. And it's surprising. Sometimes when we're going above this and then we come down, one of these lines may end up providing support. And that was about where we set the low in Thursday's session. This is longer term negative though, even though we're positive with this chart. We're hitting the upper end of this trend channel. And this could be producing some overhead resistance. And we're more to looking like a doji now, where we have the open and the close right about equal to each other with the Heikin Ashi. But most of the recent bars are positive because they're open. And we're positive, but now pointing down with the Kegi chart, where we're still positive with the Renko chart, and the three-line break chart is also positive. Long term, still hanging in there with our 150 and 200 period moving averages. And we're negative in the short term with mid caps. We switched over to negative in the short and intermediate term with the small caps. They've just, a year ago, they were a disappointment. Well, they've been a disappointment again this year as well. And bonds have switched back over to positive in the short term. Commodities are positive across the board. The dollar's still in a downtrend in the short term. And we saw energy and real estate. These are areas that have been getting hit hard. You could say at least energy is more defensive. Healthcare is also more defensive. Those were the three sectors that were up. All of the other sectors were down. The weakest area was financials. Now, that's been a really strong area lately. So for right now, we're just kind of treating that as profit taking. An awful lot of red right after the open and then going throughout the day, where the NASDAQ crossed below 20,000, 19.9, And then we had a BPI cross below 50. Well, we had just seen a BPI cross above 50. Well, now it's crossing back below. The Dow fell below 44,000. And then the euro's been going up when you compare it to the dollar, since the dollar's going down right now. And here's the Dow, just kind of drifting lower. We are starting to see a pattern of lower highs and kind of a little bit of lower lows here, but we're still above the 50-day moving average. So I wouldn't treat this as all that negative. It's really more just chopping sideways. And we've turned negative with the Elder's Impulse system with the diamonds. We dropped, but still above the 50-day moving average with the NASDAQ and NASDAQ 100. This R1 pivot point, we've been having a hard time getting above that. That could be providing overhead resistance. And we've gone from positive to neutral with the Elder's Impulse system for the Qs, but the momentum for the NASDAQ 100 is still positive. And here's the small caps. And I look at two small cap indexes. The S&P 600 dropping further down. The 50-day moving average is now also starting to decline. And we're below the second small cap index here, the Russell 2000, also still below the 50-day moving average. And we've gone from positive to negative here with the small caps, with the Elder's Impulse system. The mid caps just could not stay above this pivot point here and dropping below their 50-day moving average. Also going from neutral to negative with the mid caps with the Elder's Impulse system. This is a broad market measure. The Wilshire 5000 was down about 0.5%, but still above its 50-day moving average. We did just set an all-time high with the total U.S. stock ETF, but now we're pulling back over 0.5%. Financial sector, this is what I'm talking about. It's been pretty strong above its 50-day moving average, but we did see a decline of over 1.5%. The FANG index setting a recent all-time high, still above its 50-day moving average. And then we look at some of the magnificent seven stocks here. Apple, which is up 0.39%. Amazon falling a little bit further below its 50-day moving average. Microsoft was up over 0.5%, but still below its 200-day moving average. Meta just setting a recent all-time high, falling a little bit further, probably some profit taking there. Google still underneath its 50-day moving average. Nvidia is above its 50-day moving average. And Tesla, is between its 50-day moving average and its 200-day moving average, it fell 1.71%. Netflix coming off of setting a recent all-time high, down 1.8%, probably some profit taking. And then I haven't looked at this in a while in this video, so I wanted to go through the semiconductors. This is the SOX index, which is in a downtrend because the blue line's below the red line, but we're starting to cross back above the 200-day moving average. Can that continue? And we're seeing this ratio going back up, but we start to see some hope there, only to have this fall back. If this can continue to go up, this just means the semiconductors are outperforming the tech sector. Now, they can both be going up, but when the semiconductors are going up even more and this ratio is going up even more, that is positive. And then looking at the SMH ETF, where this is still in an uptrend and we're bouncing back up off of the 50-day moving average. And this is a rainbow look at that same ETF, SMH. We're starting to come back up out of the rainbow after we did hit some support here at a 250-day moving average. And then looking at the relationship between US and world stocks, still seeing the short-term correlation is still fairly strong. The longer-term correlation is pretty much unchanged. Oil going back up. This is what helped the energy sector. We're getting back up into the 72s now. And the dollar is still in a longer-term uptrend, but it has been pulling back lately. That's why you're seeing the euro going up and the dollar going down. And this could be helping stocks as the dollar goes down. And we are underneath the 50-day moving average and also ever so slightly below that 4.5% level with the 10-year yield. And this is the intraday chart that I've been following. Do you think this level's important? Yeah, we just kind of straddled right along that in Thursday's session. And we went up just a little bit here with the 7 to 10-year bond based on price. And if you go back here, you see the momentum. It's just flat. I mean, these things aren't trending all that much either. This is looking, I don't know, like a machine gun hit this with spots all over the place here. This is a concern that we've been watching that to this point doesn't seem to really matter all that much. The red line, which is the Japanese 10-year yield, it's continuing to go up. And we're wondering, is that going to cause some problems in Japan and then bleed over into the rest of the world the way it did last summer? All right, and so we're still above the moving average when we look at the Q's to S&P ratio, discretionary to the S&P. This is showing some weakness, and we're just a little bit below the moving average when we compare large cap growth to large cap value. So we're underneath the moving average with the small caps. Now we're dropping below the moving average with the mid caps and showing some weakness here with small cap growth to value. So what's our outlook? We're still positive but not trending. I haven't changed that because we really haven't seen much of a change. We're going to get the S&P Global US Manufacturing. That's one report. And then we'll get another report, the services PMIs, the Purchasing Managers Indexes. But this isn't a real influential report. We're going to get also existing home sales and consumer sentiment. And then keeping an eye on all the geopolitical things to see if they have an impact. But for the most part, the market just kind of makes note of these things and it doesn't really seem to have all that big of an impact overall. And here is how we're finishing out the economic calendar for the week. This also, I should have put this down here. The red area should go down around Friday's session. But seasonality, February 21st is not a very positive day. We are negative with the Dow, S&P, and NASDAQ. And we're coming further into the second part of February, which tends to be negative, as seen here, where we're seeing more of a downward move during a regular year. We also see some more weakness with the green dashed line. This is the S&P in a post-election year. And second half of February, going back to 1950, tends to not perform all that well. This also shows the weakness in the second half of February. February is also the weakest month during a post-election year. This also shows how it's weaker during a post-election year. So, the warning signs, the ease of movement, it's dropping a little bit further below zero. And that's it. That's the only negative thing right now. Our smart money indicators are still quite positive, but you could still suggest that they are extreme positive. But it doesn't mean a reversal. It's not like some of our other indicators, like an RSI or some of the short to intermediate term oscillators that we look at, that when we go extreme positive, we look for more of a decline, if not an actual reversal. This just shows that the smart money is slowing down a little bit right now. And the growth of value and discretionary to staples, they're still positive. But if we see more weakness with this, that's going to cause some more concern. The advanced decline line, especially for the S&P, those are doing fairly well, not so much for the small caps. And our McClellan oscillators and summation indexes for the S&P and NYSE, they took a hit on Thursday, but they're still positive. And we're looking more positive here with our oscillators as well, and also improving. And the copy curve is just about ready to switch over and become positive. The Swindlen Trading Oscillator is positive, as is the Parabolic SAR, the Vortex, but it is declining. And our bullish percent indexes are still positive. The money flow and the ultimate oscillator, even though it declined, it's still extreme. The moving average studies took a little bit of a hit, but still looking positive. The financial sector saw some profit taking, but still positive, as is the momentum for the NASDAQ 100. So our conclusion, I haven't changed this because nothing has really changed all that drastically. We are still positive but not trending, and that's what we're seeing in the short and intermediate term, and we continue to be positive in the long term. Thank you. I hope you have a really good day, and I will talk to you in the next video.